update from SC Securities. I'm Apsara Thurairetnam from SC Securities Research. So we are going to look at the Sri Lankan economy, recent developments and future outlook. We start by looking at the overall economy and the real GDP growth. The real GDP growth contracted by 7.8% last year in the year ending December 2022, and the reason for that heavy contraction was the low foreign exchange reserves, external sector difficulties, high fuel prices and shortage of raw materials and shortage of fuel, resulting in a heavy contraction in all the key sectors, namely agriculture, industry and services sector. This contraction continues in the second half of this year, with the real GDP contracting by 7.5% in the first half up to June 23. And we see this as the bottoming out of the economy, and we expect that from the second half of 23, we'll see better and more positive economic growth. In the second quarter of this year, the real GDP contracted by 3.1% compared to the decline of 7.4% in the same quarter last year. The contraction mainly came from the industry sector, which contracted by 11.5%, followed by the services sector, which marginally contracted by 1.8%, whereas the agricultural sector demonstrated a 3.6% growth. The agriculture sector expanded in the last quarter, mainly because of higher yields coming from the rice and cereal segment, which growth in the agriculture segment. The industry sector contraction was led mainly by heavy contraction in the construction sector, which degrew year on year by 23% in the last quarter. The services sector marginal contraction is mainly due to contraction and decline in the financial services segment, but given that the services sector is an important part of the overall GDP, we expect that this sector will rebound going forward and contribute to overall GDP growth. Last year, Sri Lanka experienced high inflation. This is mainly because of high oil prices, partial monetization of the fiscal deficit and sharp currency depreciation which took place last year, which led to high inflationary conditions. This year we see a significant slowing down of the inflation led by a tight monetary policy stance and also a tight fiscal policy of the government. And also, given a sizable base effect, we see that the inflation has come down to single digit levels in the third quarter of this year. Headline inflation, as measured by the National Consumer Price Index, has shown a steady decline from Jan onwards this year to September and October this year. The NCPI stood at 0.8% in September from about 2.1% in August. The Consumer Price Index has shown a heavy decline this whole year, and the Colombo Consumer Price Index stood at 1.8% in October 2023 from about 1.3% in the prior month. Further, the core inflation, which excludes the energy and food categories, also showed a decline to 1.7% in September compared with 4% in the prior month. We expect that inflation will stay within the CBSL's target range of 4 to 6% going forward, and inflation has been brought under control by the CBSL by the tight monetary policy stance. As inflation is brought under control, the Central Bank of Sri Lanka started cutting policy rates. At the recent monetary policy review meeting, the CBSL cut policy rates by 100 BPS to 10% and 11% respectively on the SDF and SLF rates. And prior to this, in May and in July this year, the CBSL had cut its policy rates by about 400 BPS in total. Further reduction in the policy interest rates will depend on the recovery in economic activities and on the disinflation path of the economy. But we expect that interest rates would go down even further, which will be a boost to economic growth. With the loosening of the tight monetary policy stance, we see that market interest rates are gradually easing at the beginning of this year due to high risk premiums on government securities, due to uncertainties regarding the domestic debt optimization, and also due to high policy interest rates. The overall market interest rates remained high, but with the recent cutting of policy rates and also with clarity on the domestic debt optimization or DDO, we see that the market interest rates have greatly eased. The 1-year T-bill rate had reduced to about 13% in November this year, whereas last year in December it was about 29% and close to 30%. And also we expect that there will be further recovery in economic activities and further easing of monetary conditions, which will support a further reduction in market interest rates, and we expect the 1-year T-bill rate to reduce to close to 12% by year end. Looking at the domestic money market, we see that there has been a heavy liquidity deficit in the domestic money market last year, which supported the tight monetary policy stance of the government. But this liquidity deficit gradually eased through last year to this year, mainly because of open market operations conducted by the government of Sri Lanka. Also in August this year, the central bank reduced the statutory reserve ratio or SRR on rupee liabilities of domestic commercial banks to 2% from 4%, and this released further funds into the domestic money market, which is the liquidity deficit. So currently the domestic money market is showing a liquidity surplus of close to 35 billion rupees, which is encouraging from an interest rate perspective. We expect to see, with the liquidity surplus coming into force, that interest rates will further reduce going forward. We look at the external sector next. So the trade deficit of the Sri Lankan economy had contracted in the cumulative period Jan to September of this year. The overall trade deficit was 3.3 billion USD in this period, compared with 4.1 billion in the same period last year, indicating an 18% year-on-year decrease. The overall exports in the period Jan to September had declined by 10% to 9 billion USD from about 10 billion USD last year. The reason for the degrowth in the exports was mainly due to slowing demand from key external markets, and also the imports have also degrown in the period Jan to September of this year to 12 billion compared with 14 billion in the same period last year, and the degrowth in the imports was mainly due to lower demand for fuel, textiles and articles, and machinery and appliances. And while we still have a trade deficit, the worker remittances and growth in tourism earnings and also growth in portfolio inflows, mainly in government securities, has supported our balance of payments. As a result, the Sri Lankan economy recorded a balance of payments surplus of 1.9 billion USD in this period, which is very encouraging. Due to the removal of import restrictions, monthly imports have shown a rising trend from the middle of this year, and we expect this trend to continue. And also we see that exports are still on a declining trend in the recent months, mainly because of a decline in the demand for apparel sector exports. However, foreign worker remittances continue to show good improvement this year. In 2020, foreign worker remittances was close to 6 to 7 billion USD, and this declined in 2021 and 2022. But we see a growth in foreign worker remittances this year, supported by the flexible exchange rate regime which is in place. So foreign worker remittances up to August this year stood at close to 4 billion USD, and we're expecting foreign worker remittances of close to 6 billion for this year. And also foreign worker departures peaked at over 300,000 persons last year, and we expect a similar level of foreign worker departures in this year, which bodes well for future remittances. And we expect that worker remittances will continue to grow going forward, which will support the overall balance of payments in the economy. Tourism sector shows sign of revival, and Sri Lanka welcomed close to 1.1 million tourists in the up to October 2023, indicating a year-on-year growth of 98%. We forecast that tourism earnings will continue to improve this year, and we are estimating tourism earnings of close to 2 billion USD this year, and bodes well for the external sector. With the growth in tourism earnings, worker remittances and portfolio inflows into the government securities market, we see that foreign reserves have greatly improved this year, and forex reserves stood at USD 3.5 billion in September 23, and also payments funds inflowing from multilateral agencies such as the World Bank, ADB and IMF have also supported the foreign reserves. And we expect foreign reserves to continue to remain steady at close and above 3 billion USD going forward, supported by the multilateral agencies, and also due to the improvement in tourism earnings and worker remittances. We expect that foreign reserves will continue to remain steady going forward. Last year, the rupee showed considerable depreciation and depreciated to close to 360 and nearly 370 rupees to the dollar as the soft peg of the Sri Lankan government was removed. However, this year, supported by a current account surplus, the rupee has shown some level of appreciation and has appreciated by close to 10% from the beginning of this year. And the Sri Lankan rupee stood at 328 rupees to the US dollar in the first week and second week of November. And we expect, however, that with the removal of import restrictions and growth in aggregate demand, and as the recovery in economic activities continue, the rupee will face further depreciation going forward. Next, we look at the fiscal side. High fiscal deficits have prevailed in recent years, and the budget deficit as a percentage of GDP stood at 11.7% in 2021 and was about 10.2% in 2022. In line with IMF expectations, the government has reverted to fiscal consolidation and is targeting to reduce its budget deficit to 8% of the overall GDP in this year, supported by higher revenue bases coming from higher taxes and also reduction in recurrent expenditure. In September 2022, the Sri Lankan government entered into an agreement with the IMF for a budget support extended fund facility. The extended fund facility emphasizes fiscal consolidation as well as institutional reforms to SOEs. So in line with the IMF reforms, the government increased taxes. The tax-free thresholds were reduced. There were higher income and corporate taxes, further higher VAT rates, as well as higher excise duties on certain goods. And also the government undertook expenditure rationalization measures. However, expenditure remains high, mainly because of high interest payments due to the elevated debt. The government's fiscal consolidation program, fiscal balances are expected to improve going forward. The budget deficit stood at close to 1.5 trillion LKR in the period Jan to July 2023, compared with 1 trillion LKR in the same period last year. And we see that during this period that there has been a growth in total revenue of 39% to close to 1.5 trillion LKR, whereas recurrent expenditure has grown by 42% to close to 3 trillion LKR. Public investments have remained fairly stable during this period compared with last year. We expect that going forward with the SOE divestments, the fiscal balances of the Sri Lankan government will further improve. The Sri Lankan government has currently listed 7 SOEs for divestment, namely Hilton Hotels, Hyatt, Sri Lanka Insurance, Sri Lanka Telecom, Lanka Hospitals, Litro Gas, and Sri Lankan Airlines. The government expects to raise close to $4 billion from the SOE divestments it plans to undertake. And also the government has introduced cost-reflective pricing for the Ceylon Electricity Board and also for the Ceylon Petroleum Corporation to reduce its losses. And these two entities are also expected to be divested or restructured in time to come. And their government has already called for expressions of interest in Sri Lankan Airlines. And we expect to see a divestment in that also in the near term. And we expect that the SOE divestments will remain on target with the government's plans. The government plans to divest its SOEs that are listed for divestment by the first quarter or the first half of next year. And this will also reduce a lot of the recurrent expenditure of the government and support the budget deficit. A reduction in total government debt is required to achieve macroeconomic stability, and we see that central government debt, which includes foreign debt as well as domestic debt, had increased to 27.5 trillion LKR in December 22, and in August 23, the same was 27 trillion LKR. And the debt to GDP ratio was close to 114% in December 22, which is significantly high for a developing country like Sri Lanka. And in line with the IMF reforms, the Sri Lankan government is actively targeting to reduce its debt to GDP ratio to close to 95% over the next few years. And we expect that with the introduction of the fiscal reforms, with the SOE restructuring, SOE divestments, with the possible and potential introduction of wealth and property taxes, and also with the overall debt restructure that is ongoing, we expect that Sri Lanka's macroeconomic performance will improve going forward. For this, the Sri Lankan government is currently undergoing an IMF program, and with the conclusion of that program, they expect to see that the overall economic picture should improve. And also, we expect to see GDP growth in the next quarter and in the following year. This year, GDP growth will possibly be negative in the range of -2% and -4%. But next year, we see that GDP will improve. We have an expectation that GDP growth will take place, go into the positive territory from next year. And this bodes well for the overall economic health of the country. Thank you.